why regularly changing your investments will cost you in the long run. And connected to that, Warren, let's kick off with a call, shall we? From Peter in Durbanville. This is a good one, Peter, and I think a lot of people sit across the table from their financial advisor and they get this question posed to them. What are you worrying about?
Well, good evening, gents. I just want to know, I know it's not a good idea to switch investments all the time, but I do know that it's necessary now and then to rebalance your investment portfolio. And if my financial advisor doesn't do that and the investment doesn't keep up with the times or with the change in economy, what's my recourse, firstly? And then in terms I know if you make regular switches, you also trigger capital gains tax events. And maybe if you can help me out and elaborate a bit more on how that works.
Well, lovely, Peter. Thank you. That feeds very nicely into what we're talking about this evening. Peter in Durbanville, Warren Ingram. Rebalancing portfolios, regular switches, chopping and changing. They're three sides of a three-sided coin.
Yeah, so as you say, it's a fabulous, set of questions. So I think the first thing, Peter, is, so you're breaking it up into two issues. One is about the recourse. So what if your advisor's not doing their job? And that becomes, I think, maybe a bit of an easier answer. But the first part is just to determine whether your advisor is doing the job for you or not. So rebalancing a portfolio is important. For example, if you've got, let's say, one unit trust that invests in shares, one that invests in government bonds, one that invests in property, and over time, that mix goes out of whack. You started life with 50% in shares, and by the time it's done, 3 or 4 years later, you've got 20% in shares, or you've got 70% in shares.
Markets either fell so badly that actually now the bonds are a bigger part of your portfolio than they should be. There's a mismatch, according to your investment plan and your strategy.
Yeah, so you either end up taking too little risk and you're not going to beat inflation, or too much risk and you might lose capital permanently. If that's the situation, and you should be rebalancing regularly, and your advisor's not doing that,
what's regularly?
So to me, with that example, I would say regularly is once a year, and you should be doing it at the same time every year. And the reason for that is markets do just move in cycles. So within a year, stock markets can and regularly fall by about 10%. In a yearly period. It doesn't mean it falls 10% for the year, but there'll be a month or two where you just see a significant drop in the market and then it recovers again.
Then to Peter's point, though, that if you keep rebalancing and every year you're rebalancing, it means that you're buying some things and you're selling some things. And if you're selling some things, do you not trigger a tax problem? Because now suddenly SARS says, but you're trading. You're not reinvesting. But I'm rebalancing. No, you're trading. There's too much activity in this investment portfolio. We class you as a trader.
Yeah. So that's going to be, it's going to be an issue to manage. So one of the things is SARS says that if you hold an investment for 3 years, then you're automatically not a trader. So then it's automatically, there's no question, there's no debate, it's capital gains. But it doesn't mean that if you sell something within a period less than that, in other words, you do rebalance once a year, that you are automatically a trader. It's going to be the intent. Why did you take the action that you've taken? And you are entitled to manage your risk. That is so there's nothing wrong with that. Obviously, if you're making massive trades every year, where you're switching your entire portfolio on an annual basis and then saying, no, I'm just managing my risk. Well, SARS is not stupid.
Yeah.
But if it's legitimate, and remember, it's small amounts that you'll be doing. So you'll be doing it usually at the margin. In other words, you started at 50% in shares, and actually now you're at 60 or you're at 40, and so you're tweaking that. And so that rebalancing, yes, you're paying tax, but what's interesting about that is every year you're allowed to make 40,000 rands worth of profits that can be given to you tax-free, capital gains tax-free. So actually, if you're doing a little bit of rebalancing on an annual basis, you're actually taking advantage of quite a nice, not a loophole, but a advantage allowed to you in the Tax Act. So I don't mind that rebalancing of small amounts. And I think if your intent is right and it's a proper portfolio process, great.
Now, to the crux of his question, what happens if his financial advisor is not doing this?
So I think a couple of things. One, clearly you fire your advisor immediately. I would always give them one chance to explain. So I would say, set up a meeting and say, we agreed that we were going to rebalance and it's been 3 years later and you've done nothing. I need to know in writing from you after this meeting why. What did you do? This is what we agreed up front. Bring me the plan, the document we set up on day one. This is what you said.
And that document should specify what we've agreed.
Exactly right. And if it doesn't, the advisor starts to be at risk here, because eventually what's going to happen is if you can point out to the advisor that they haven't done their job, well, you don't have to point it out, but if you figure out that they haven't done their job, you can report them to either to their internal complaints process, in other words, to their compliance officer or their boss or whatever the deal is, or if you feel like you're getting no help there, then you go to what they call the FAIS Ombud, the Financial Advisory Intermediary Services, FAIS, FAIS Ombud. And that's an ombud. That's somebody that's their job is to determine whether you've been advised incorrectly.
Or you just fire them and get a new financial advisor and be more careful next time and lean harder on the next financial advisor.
Well, I think if you've experienced a significant loss as a result of the advisor's inaction, then you want to get money back. But if it's no big deal in terms of actually whether you've made a profit or loss, then I agree with you. Then you fire the advisor, get one that's actually going to do their job, stipulate things, and then make sure that the meetings happen. So to me, I would just staying on a 3-year example. If you haven't had a portfolio rebalance in 3 years, and more to the point, if you haven't had a meeting with your advisor in 3 years, I'm also going to point a little bit of a finger at you. Not if I was your advisor. If I was your advisor, you should fire me. But as the outsider looking in, I'd be saying to you, look, you are responsible ultimately for your own money.
Yeah, I mean, and you can blame your financial advisor if you
they are wrong,
and they're wrong, but that's not going to help you.
Yeah.
When they've moved on or retired or died or whatever the case is, and you're left with the problem of having badly managed money.
And surely once a year, you can put in your own diary once a year to say, hang on, let me just check that everything that we've agreed is being done. And if it hasn't been done, let me pick up the phone or drop a mail to my advisor and say, what on earth is going on? I don't think that's that much responsibility for an individual looking after their own money.
Then to the core point about the risk of regularly changing your investments. Because when you're talking about sort of rebalancing, you're not sort of saying, resources this year, banks the year after, then some insurance, and then maybe I'll go into retail. That's the kind of crazy that is going to cost you money.
Exactly. One of the things I was looking at was, the question I'm getting asked a lot over and above, what's the future of our country? Because that's the one I'm answering the most, and I can't give a proper answer there. But the other one is then, the JSE is just going nowhere. We've seen just, over longish periods of time now, we're getting no returns.
That wasn't yesterday, but since then, it's at a record level of 56,750 yesterday, and today a record of 57,000. So that one's answered.
But actually, over 3 years, you probably only really made about 21% in total, not 21% a year.
And that's basically kept up with inflation.
Inflation has been about 17% over the same time. So you've moved, over the last couple of days, I haven't really counted those, but let's just say your capital's grown by 4 or 5% above inflation.
It's insignificant.
It's not material. So that's the problem now. People are looking at this and saying to themselves, what do I do now? Where do I go? Where do I find growth? They want to take action. And that need or that urge to take action often is the cause of the next set of disasters, because we're looking at a time where the JSE to me is not massively expensive. I don't think our whole stock market is very expensive. We've got a few shares, Naspers absolutely leading the pack, that I think is ridiculously expensive, but the rest of the market is just not. It's just not an expensive place. And so if you're in shares now and you're unhappy and really irritated with the lack of growth and acknowledging that there's lack of growth, switching now, just before, let's just say someone had switched June. We've seen July gave us fantastic returns. August wasn't bad. September was not great, but beginning of October looking very good again. Yeah. So suddenly you could be missing out on 10 or 12% growth for the last 12 months.
But there are times where it's right to change, and then it's telling the difference between when is a good time to change and when is not a good time to change. You're not saying don't ever change. You may have a really bad investment strategy. You may have taken some bad advice. You may have made some bad mistakes yourself.
Yeah.
You don't sit in a losing position in perpetuity.
No, and I think you need to understand why. So if I was using Peter's example, let's just say his question had been, my equity fund had only given me 8% a year for the last 3 years. My advisor's bum, fire him. I want a new advisor and a new fund. I would have said to him, but But Peter, the stock market's only given you 7% a year for the last 3 years. The fact that your fund has done 8% a year for the last 3 years, you're actually doing okay. You're doing better than the market. So you have to understand the context in which your investments are operating at that time. What's the tide doing? Is it coming in? Is it going out? At the moment it's going absolutely nowhere and there's no wind, so you're just drifting. But so to me, that's the important thing to understand. And then that comment with the rebalancing is important. So if you are rebalancing, that's strategic. That's a long-term game plan. But if you're just chopping and changing, looking for tomorrow's next big jump because you've gone nowhere for now, so the classic right now is shares are going nowhere. Let's pile into Bitcoin. That's not strategic. That's not an investment strategy. That's called hope. And I'm afraid hope is not an investment strategy. And for someone who's in shares at the moment who says, you know what, I should just sell everything and go straight into Naspers, I'm afraid that's also not a great idea. You don't know that it's going to continue on this path. So those are the bad decisions that people are making that we think, I think they should avoid.
Warren Ingram from Galileo Capital, taking your calls, taking your questions this evening and dealing with issues, the thorny, the personal, the deep, the complicated issues. Because it matters to you, because it's yours. You worked hard for your money. Sound like a financial services advert, but it did. Yeah, you work hard for the stuff.
Sounds like a song.
And you work hard for them. We're not going to sing. Please don't. Jingle, quickly. Stop me singing. That was fun. Welcome to the Money Show this evening. We've got Warren Ingram in the studio. He takes us through personal finance,